Hello, I'm Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our May 2026 review and outlook presentation. Now, regardless if you're watching the video or listening to our podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlooks. For more details, please contact your financial advisor, and thank you again for joining us. So the theme for this month, for May 2026, is higher food and energy prices are not enough to derail the U.S. economy. Now let's talk through some of the broad outlook points, and I'll dive into a deeper explanation. So the conflict in the Middle East, the duration is absolutely uncertain, but the consequences so far are quite clear. Higher energy prices are driving up inflation, eroding purchasing power, weighing in on consumer sentiment, and lower income households are actually bearing the brunt of this burden. That said, and we're not trying to minimize the impact to households and families, but when we think about the global or the U.S. economy more broadly, spending on energy today is actually a fraction of what it was during the energy crisis of the 1970s, early 1980s, relative to overall consumer spending. So we spend for every dollar in household consumption today is a fraction of what it was relative to overall spending back then. And this shift is really important because it limits the overall broad economic damage, we think, to the U.S. economy. Now, separately, we see a lot of consternation about the labor market, slow jobs growth. We think that the slow jobs growth we're seeing is more of a supply side constraint, not a lack of demand for workers. And we see that in a couple different statistics that we'll talk about. Regarding inflation, we do expect headline inflation to stabilize around the 3% rate. That actually has been our expectation for some time. And specifically here, we think it's helping to pull down the rate of inflation, which is to slow the rate of the increase in prices year over year, is that shelter costs, which is the single largest part of the inflation basket, have been stabilizing. So housing prices aren't climbing like they had before. In the other areas of the consumption basket, prices are stabilizing as well. So the year-over-year comparisons become easier. So we think we should get used to about a 3% rate of inflation, which isn't terrible. Actually, that's what we saw during the boom years economically of the 1990s. Similarly, we think GDP growth, so economic growth, should remain rather solid and supported by, among other things, further economic stimulus, or fiscal stimulus, I should say, through the first half of the year. Now, our position in our portfolios is designed to be resilient across a range of geopolitical and energy market outcomes. Like I said at the beginning, the outlook for this is highly uncertain. As a result, we've structured our portfolios to be able to mitigate risk and manage through a number of different potential outcomes. So let's talk about personal consumption and oil. In this graphic, we are looking at the blue line is energy, goods, and services, how much we spend on energy in aggregate as a percentage of the total consumption basket, personal consumption expenditures, or PCE. And you can see how this goes back to 1970, how it increased through the 70s, until early 1980 or the 1980s, when it peaked at about 10%. And then we've been on a decline ever since, despite bouts of energy price spikes here and there. And today, most recent statistics are that we, as a society, spend only about 4% of our consumption basket is taken up by energy. So less than half. Every dollar spent today, less than half of what was spent in the late 70s and early 80s. And that potentially limits the economic damage overall. It doesn't mean things feel good, but when we talk about the economy, it limits the potential risk there. Similarly, actually, over the same time frame, we've seen a decline over time in the amount of money that per dollar spent that we spend on food has significantly declined, where it was double digits in the 1970s and declining throughout the 80s and 90s, and it's kind of stabilizing over the recent decades at less than 9%. So it's well in the single digits. So we spend about half of every dollar spent on food as we did, say, in 1970. So again, we're not minimizing the hardships that families are facing, especially the lower income families that are really struggling with this. But when we think about the impacts for the overall economy, they're far more limited than they were 50 plus years ago. When we think about jobs creation, things has shifted here as well. What we've seen for the last couple of years, and what we're looking at here, the blue line is the monthly jobs creation number, and you can see how volatile that line can be. So we actually smooth it out. We like to look at it on average over, in this case, a moving 6-month period. Kind of makes the picture more clear for us to understand what's really happening instead of looking at the month by month. And we also see the previous cycle average. This was the business cycle from July 2009 up until right before the pandemic. And you can see here we were creating on average more than 150,000 jobs a month back then. Society hasn't changed that much in terms of the need for workers and so forth, but the jobs creation has been significantly below that for the last couple of years. And without the economy tipping in recession, what we're seeing here is actually jobs, the number of open jobs is quite similar to what it was on average during that previous business cycle. The key difference here is that we just don't have as many new entrants into the workforce. So the growth rate of the labor force has slowed significantly, especially as we've seen some older workers retiring early. That's been a trend we've seen for the last couple of years. So there really just aren't that many people. We look at this a number of different ways. There aren't that many people relative to the entire labor force that aren't still looking for work. So we think that the slower jobs growth is actually more a byproduct of there just aren't that many people available. But importantly, as the situation evolves with the economy, we actually anticipate per worker productivity to increase. Or here we're looking at output per hour. And what we see historically is that when businesses in our economy invest large sums of money in productive capacity, in the years that follow, we see an increase in labor force productivity. And this is important because if you're going to grow an economy over time, it really relies on two big factors. One is the growth rate of your labor force, which we already said is slowing or has slowed. And secondly, it's the how productive is that labor force? How much more productive is it from one year to the next? And what we saw in the 1980s and 1990s was a massive investment in infrastructure and information technology during that information technology revolution that really paid off in a jump in labor force productivity, worker productivity that you can see here in this chart. And importantly, that can help drive higher incomes, and it's not inflationary. We expect to see, based on the massive amount of investment we've seen from the private sector in industrial capacity in general, and in technology like AI in particular, we expect that to lead to a boom in labor force productivity for the next decade to come, which is to say, we think the next 10 years for an economic growth will be as strong and as healthy as anything we've seen since the 1990s. So we're looking for kind of a repeat, maybe even a stronger repeat than what we saw back then. So in terms of investment implications, we have increased our allocations to U.S. equities in our growth, moderate growth, and conservative growth strategies by paring back some of our foreign equity exposure. But because we do think that, while I mentioned the U.S. equity or economy reliance on energy has lessened over the years, other economies, other major foreign economies are far more vulnerable, in our opinion, to those risks. So we just pared back a little bit there and are emphasizing more the U.S. Overall, our existing themes remain the same. We continue to favor U.S. industrials, the information technology sector, regional banks, and some select emerging markets. We've been pretty consistent with that theme for a little while now. Within fixed income, we did add some mortgage-backed securities in there. We think the yields are attractive and they're very favorable risk-return profile. And we maintain our emphasis on limiting our duration, our interest rate risk, which we think is important given our outlook for potential interest rate volatility. On the alternative side, alternative investments, we continue to favor equity options overlay strategies for current income and to help mitigate some risk, as well as a multi-asset low return strategy that can help mitigate some inflationary pressure and provides a lower correlation source of return. So the alternative space really is a third place to find returns, and we think is going to continue to be very important in the months to come. As I mentioned earlier, our position is designed to be resilient across a number of different potential outcomes. And here on the next slide, you can see our favorable choices that I just mentioned: industrials, regional banks, technology, and so forth. Now, the cash indicator, after a prolonged period of relatively low levels, which in our view suggested an amount of investor complacency, which itself creates risk. When the market's not pricing in much risk, then small things can upset the apple cart. And of course, today we're dealing with not so small things, but things have actually moved back towards the long-term median. Historically, when we see the readings of the cash indicator at these levels, this has been consistent with markets functioning in a healthy way, despite occasional bouts of volatility. So the current levels suggest that investors are being adequately compensated for taking risk. And with what we think is a relatively positive economic backdrop for the U.S. overall, we feel like equity market volatility is not something to be feared, but it's to be expected and an opportunity to put money to work. And with that, I will close by thanking you for your time and your interest. And again, if you have any further questions, please contact your financial advisor. They'll be happy to help.